Once she's getting Serhan. I'm the board member of the Canadian Business Council. So the Canadian Business Council's purpose in the UAE is to connect Canadian to businesses in the UAE and to provide an easy access and sharing information for all those people being here for a short term or for the long term. So usually what we do, we have, so usually what we do in the Canadian Business Council, we have our team who's working back in the backstage, connecting to all Canadian and giving care of our members. So we have 500 plus members that they have, we share with them all the information, and we have our sponsors as well. So all those sponsors, they are supporting our events, and without them this event couldn't happen. We have, besides that, all our members, they get a discount price on all this event, that this can easily for them to access and have insights and connect with people from their industry. I would like to take a moment to just thank our sponsor, our strategic airlines partner, Emirates, and Government of Saskatchewan, and definitely the Canadian University of Dubai, and Affili and Angel. I would like to hand the mic to my colleague Hanan, so she will introduce our speakers for tonight to discuss the Canadian tax for expats in the UAE. Hanan.
Round of applause to Ismail. Hello everyone, I'm Hanan Ilaiti. I am at COD as head of departments for corporate training and lifelong learning. I'm also part of CBC. I'm heading the Connect group and I'm heading the Canada Club as well. So much to do there. I'm so excited to partner with CBC to bring these events here. We are partners. Of course, this is a Canadian home. Don't you feel in Canada? Don't you? Yeah. Who's Canadian here? Great. This is great. So we have so much to learn. Tax. We don't want to go home and have any surprises. So I want to thank our speakers, Sahara Kings and Wayne Bewick, for coming here and for sharing their knowledge and expertise. How we will do it is that Ara will go first and he's going to speak, and then he'll stop, he'll take your questions, and then we'll move to Wayne. And then he'll do his talk as well, and then you can have an opportunity to ask your questions. Welcome everyone. Thank you for COD folks to be here. Thank you. And I'll pass the mic to Ara.
Thank you. Thank you everyone for coming. It's great to be back in Dubai. I used to live here for 16 years. And I think I've been in your shoes. I've attended these events, listening to Wayne, Todd, talk about taxation. And I planned my exit from Dubai, and I delayed it for 4 years. So I changed my mind for reasons after attending such an event, by the way. So I'm grateful. So I'm a client of Trowbridge as well. I've been in your shoes. I'm not here to talk about tax. So tax is about saving money. I'm here about how to make money in Canada. So we have a firm there called PE, which invests in businesses in a very tax-effective way. So that's what I'm here to talk about. Now, in this room, may I ask, are most people non-residents, I'm assuming, and what type of investments do you have? So if you have investments in real estate, if you could put up your hand for a sec. And then if you have investments in the public markets, and then anyone invested in private equity. Okay, we have one. So in Canada, it's geared towards actually non-residents actually pay less tax than Canadians in Canada. There's a lot of tax advantages of investing in private companies, and that's what we do. So this is a slide that shows where the ultra-rich invest, the 1%. So the 1% actually invest in businesses and real estate, and you can see at the other end, only 9% invest in that. And in the middle, you have something in between. And the reason for that is the returns, and you could see in private equity funds, this is over a long period, The returns for private equity funds is generally higher than most asset classes, so including real estate. And this is over various terms. And in Canada especially, it actually favors private equity investments or private business investments, which we'll get into in a sec. And the problem with investing in private business is access, really. That's one of them. It's really designed, the private equity funds are designed for the ultra-rich because you need high dollar investment value. So generally, it's about $1 million. No problem, yeah. Yeah, no worries. So generally, the minimum investment for private equity funds is about $1 million. It's a long-term hold, 7 to 10 years. And really, the private equity fund managers make the decisions, which is, if you're ultra-rich, you don't have the time to make those decisions anyway, so it works out really well for them. And that's why it's the highest return. It's a long-term horizon. So what we do is we actually, we go after private investments like you would at a private equity fund, but we post it on our platform where the investors choose what to invest in. So giving access to accredited investors. So the definition of accredited investors, most people here would qualify, would be someone with liquid assets of more than $1 million or generating more than $250,000 a year as a single person or over 300 as a couple. And the difference with our platform is that there's liquidity. After you invest, you could actually trade those shares within the platform. So you could sell it after a 6-month hold. And we have, through our platform, you get all the reporting. And what we target is small business owned by boomers. So we don't invest in startups. We invest at the other end, people retiring. Because in Canada and North America, majority of businesses, over 40%, are owned by baby boomers, and they're looking to retire. And the majority of an economy is generally 80 to 90% of businesses are SMEs. So all those people, what's happening now is they have a couple of options. They sell the business, or more likely they're shutting it down. So a lot of businesses we see, they've built intellectual property over years. We just bought a business like that. And they're done. They want to retire, so they exit. And they usually shut it down. So we target those companies that are looking to retire. So we're registered as exempt market dealer, which means we're regulated by the OSC, by the Securities Commission in Ontario. And we lead the investments. So it's not just, we're not brokers. So we act as investors ourselves. We invest our own money in these deals as well. And what we feel is that what we do is we give access to accredited investors, but we're really positively impacting SMEs. Because one business we just bought, we'll get into, if it wasn't for us, they're shutting down, and it was their customer that approached us and said, this is a great supplier vendor that we really need. Could you please buy it for us? And we did. Otherwise, it would have shut down. And we use this platform. So I'm not going to show you the video, but it's basically a technology-based. Has anyone heard of AngelList? So it's similar to AngelList as a platform, but AngelList is designed for startups. So we're definitely not for startups. We're for cash flow positive businesses. And if very similar to that, you log in and you look at the various opportunities and you decide what to invest in. And what we're trying to do is because we're going after smaller transactions, the cost of a smaller transaction is almost as much as a bigger one. So we're using a repeatable process and model. So the costs are managed, especially the legal costs. So this is the team that we have. We work with partners who bring us deals as well. And the target, you're thinking, what kind of businesses do we target? Like we said, we target people retiring, and we also support management buyouts. So that's when, and we really like management buyouts because the employees who've been working there actually know most about the company, and we facilitate them being shareholders as well. Because we're not there to operate the company day to day, we're there at a board level. So we like it when there is a second level of management and we support their share ownership. So we lend them shares, we lend them money towards those shares. So you can see the EBITDA we target, so our earnings before interest, tax, and depreciation is quite small, 300 to 3 million. So a lot of companies, funds are definitely not looking at that size of a business. And why 3 million? That's when we actually look at minority stakes as well. So we're doing two things that the market's not doing. First one is looking at smaller transactions, EBITDA over under $1 million. So it's not competitive at all. We're not paying very much for these companies. And that's when we take a majority stake. And at the 3 million level or over $1 million, we're happy to take minority stakes as well. Because as you'll learn later, has anyone heard of the lifetime capital gains exemption? Right? Do you know what it is right now? What that amount is? Very good, very good. Yes, so it's at 970 now. What it is if you own shares in a private company in Canada, Canadian controlled, and you sell your shares, let's say you invest 10,000, you sell it for $1 million, that capital gain is 0% capital gain. There's no tax whatsoever on that, right? Most Canadians have never used it and most Canadians don't know about it. And it's to promote business ownership, private business ownership. And that's where a lot of business owners actually, that's their pension. So when they retire, they sell their business, and that $1 million for each Canadian is tax-free. So if they have a spouse that owns shares as well, that's another $1 million. So that's where we offer the minority exit for companies who, let's say they have a sizable company making 3 million EBITDA. If they want to take $1 million out in salary or dividend, they're going to pay a very high tax on that. So if we were to acquire a stake at a fair price, that $1 million is tax-free. And that's one of the options we give. The stage of the business, again, it has to be established with a good reputation, so no startups. The sector, we're very agnostic, and the way we think about it is if it was bigger as a company or better managed, had better systems, then private equity would be interested. So our exit is really to sell to private equity. And the investors we have are exclusively accredited, more high net worth individuals or family offices, because we want a sophisticated investor, and we're regulated by the OSC, and that's our minimum investor level. And the deals we look for are opportunistic, and truly we look at it, if we can't add value to it, then there's no point. So we have to be able to add value. At the small business level, it's not hard to add value because it's owner managed. They're not the most sophisticated in terms of marketing and systems, so it's fairly easy to add value. And we target 25% IRR, that's return over time, that's an annual return. But we focus on dividend yielding. So we do want dividends to be paid. We're incentivized, our fees are based on the dividends our investors receive. So we definitely prefer dividends, and we target dividend yielding investments as well. How the platform works, it is very new. We haven't come across any company that's doing what we're doing. And this is what it looks like on the phone. And this is what the performance you see in terms of reporting. So how we work is there's no fees, there's no commitment fee. You could register, and you have to onboard if you really want more details. And there's no fee whatsoever. And then you make the investment decision. So when we come across a deal, and there are not a lot of deals, I have to be honest, because we're extremely selective with the deals. And we don't post a deal unless it's 90% going to close. because we don't want to waste your time, we don't want to waste our time. And so there's, a deal is posted, and then you see a teaser, you watch a video, if you like it, you show your interest through the platform, and you put in the amount you're interested in. Until then, there's still nothing binding, you could change your mind. And then until the investment is made and you transfer your funds, you could change your mind. So the decision is yours. And then the reporting is done through the platform as well. There's a data room in there. And then once you invest after 6 months, you have the option to sell. You set the price. So how the shareholders agreements work is, and one step back, it's, if you're used to, excuse me, sir, you've invested in a private equity fund, is it an LPGP, it's a partnership agreement? Yeah, so typically funds are through partnership agreements. It bypasses securities laws, so you can do that. So we could have done that, but we chose not to. So what we do is actually issue shares. So you invest in a holding company, you have a shareholders agreement, and you have and within the shareholders agreement, it allows you to trade shares. You must offer it to your other shareholders first. So that's what the platform does. You set the price, we have to approve it, and the offer goes to other shareholders. They have a 30-day decision to make. If it doesn't get taken by anyone or the group, then it's offered to our wider investor base. So what we're trying to do is give access to liquidity. It doesn't guarantee liquidity, but depending on the price that you set. And the price is set by you. And the beauty, because we've been tracking performance all this time through the platform, it's easy for us to market that offering because we duplicate the information so any new investor can access that information fairly easily. The tax advantages, our structure is that, so each portfolio company is held by a holding, a separate holding, so that it qualifies for the lifetime capital gains exemption. And what we truly feel what we're doing is we are positively impacting small business and especially not just people retiring and saving the intellectual property they've built, but we're also promoting business ownership. So one transaction that we were working on for 3 years on this transaction, it was 2 owners, one was 81, the other one 75, very stubborn, I must say, and they delayed. So it was a very interesting business. We were going to give shares to one of the managers. He definitely could not afford the shares. Last minute, for whatever reasons, it was something risky came up. We said we pulled out, and they had just prolonged it. And then we supported the manager, actually. We advised them and helped them do a management buyout. And he ended up, him and another employee ended up owning 100%. One of the shareholders was kind enough to gift 50% of the shares for free to the 2 guys. So we were a part of it. We made, we wish we invested, but it wasn't the right investment for us. But at least that company, didn't close down. So it is making a positive impact. The tax advantages. So whether you're Canadian or not, resident or not, these investments, let's say you invest $100,000, when you get the first $100,000 back, it's actually on a tax-free basis. So that doesn't matter if you're resident or not. And that's because we treat it not as a dividend, but as a capital repayment. It adjusts your puck as well. Now, Wayne, I'm a CPA, CA, but I know very little about tax, and Wayne is the expert. So, but the beauty of the investments we look at, it's mainly in Ontario now. It's a very low tax rate for small business. So it's very favorable, 12.5%. And after this is for non-residents, once you get your return of capital, any dividends, there's a 25% withholding on the dividend. And if you sell your shares, now remember, you don't have to wait for us to sell the entire company. You could trade your shares at any point. And if you do, there is no taxable capital gain for UAE residents. And that's for Qatar, anyone in the Middle East, really. And if you are a resident, you still qualify for the lifetime capital gain. Now, it's really quickly, these are the investments we made. And we don't like shiny objects too much. We actually like industrial, cash flow positive companies. So the first one, we purchased an 80% stake. We're really happy with our partners. We get along really well. And we doubled revenue in the first year. We took a risk during COVID, actually. And admittedly, our partner admits that if it wasn't for us, it was a risk to take. We took on a $2 million contract that, during COVID, if they didn't pay, would be in financial trouble. And so we took the risk, and it worked out quite well. So we've already repaid 80% of the capital. This year, we're doing quite well. We invested last year in hiring someone from Lafarge, which is a customer of ours, and we were able to set in the systems last year, and this year we hope to pay over a 50% dividend. So we'll have the capital returned as well as positive, and the valuation has already gone quite nice. So what we did there was really put in some systems and really marketing. If you Google the sector, refractory services, we're on the first page, which is great. It's easy to do when it's such a unique business, but it's made a big impact. We get customers approaching us, and funny enough, it was Google that helped us to get the third deal, because the third, I'm just going to skip the second one. That's the asset purchase I was talking about. So the company that we bought, we purchased the assets. They make the refractory brick inside these fireplaces. So have you guys heard of Napoleon Wolf? So it's made in Ontario, very good company, and they approached us, and because their supplier in Barrie was going to close down because rents in Barrie went sky high, and the owner's like, I've had enough, thank you, I'm going to shut it down. So Napoleon Googled who can make refractory material, came across us, called us and said, do you guys want to supply or buy the company? Now, the technology they had was fantastic. We couldn't reverse engineer what they were doing. The process was unique, and it was going to disappear. So we ended up buying it. Great relationship with the seller. He's still working with us, and we're already started production. So that's why our strategy is really to hold these companies, because it could result in other acquisitions. And we were given a purchase order by Napoleon, and we bought the customer list, obviously, and as well as the technology. The IP is great. Like, it really is a really good product, that the formulas that they have. So that worked out quite well. And another transaction we did is through one of our partners who's been working with this company. Actually, we could name them. They're no longer confidential. So the first one is Kingston Refractory. The second one is called Doosan Architects. So it's an architect firm that's been in Toronto for quite some time. And years ago, they started focusing on sustainable architecture, which is a buzzword now, but they've been doing it for quite some time. So everything they do is sustainable. And we really like that approach. And so we bought just a small stake, 20%. And that's the minority risk that we're willing to take, and with an option to buy another 24. And these are the type of designs that they do. So not just only they look amazing, but there's element of sustainability in everything they do. So if anyone wants to build their own house in Canada, please, Doosan Architects, Doosan.com. So so we're really happy with that relationship too, because we're helping them scale up. So whenever we see a transaction, we score it this way. So this is our own way of doing it. And you could see low entry valuation is scored is very important on the scale for us. And we generally look for a score of over 70. And this is a transaction that we're currently negotiating. And so at any time, there's about 5 transactions we're negotiating. They don't all close. So far, we've been pulling back, just being ultra conservative. And that's it. So, yes, questions? Okay, so the question is, it's a diversified sector we invest in. Do we get involved in the management of the company? So, very good question. So, how it works is we don't get involved in day-to-day, and every transaction has to have an operator. So, either it's the owner staying for a few years, or there's a level of management that we could promote up. We definitely don't claim to be the experts. So the other option we have, so we're scaling through partnerships. So we have friends, people we know who also, they don't want to work. They've done well over their lifetime. They have a bit of money and they have time to invest, not for day-to-day, but to manage their portfolio like we do. And we look at, for example, there's someone that has investments in the golf sector. We're looking at a golf-related transaction. He would be the first investor to come in and potentially help manage that portfolio and get part of the rewards that we get and be involved not just at the investor level, but at the board of directors level for oversight and guidance. So that's how we work. So we definitely don't have in-house, but we try to bring investors or promote within the company. Any other questions? So one question I get a lot about real estate. So the real estate investment does not qualify for the lifetime capital gains because Canada wants to promote business ownership and property is not. So investing in a business is definitely more favored from a tax perspective than investment in property. Yes?
For how long do you hold on to these investments in these companies? Is it you have a timeline where you sell, you keep them 5 weeks, 10 days, a year, how long?
Okay, so very good question. So a fund normally has a lifetime and they have to exit within, say, 7 years. They have an extension. So the reason we don't is because you could exit at any point in time. So there is no time limitation for us. So if it makes sense to hold it for dividends, then we hold it. So we don't have a mandate to a time that we must sell. But the goal is, so we're buying companies at, say, it's a $500,000 EBITDA company. We're paying about 3 times EBITDA, which is pretty low. So it's very, very good. And if you add 2 or 3 of these companies, let's say you have no synergies between them, so you're not having any savings and costs, but just common management, say, and you're at $1.5 million EBITDA, your multiple has just increased to 4 to 5. So just that alone can give you a return. So at that point, if we were to receive an offer, then we could sell. So it's really the PE gate decides if the whole shareholding is sold. That's when it makes sense. If we do have an offer that makes sense, then we would exit. But if you choose to, for whatever reason, liquidity event or you want to exit, then you have the right to sell after 6 months. Yes. Yes, so very good question, because fees and funds are generally hidden. And I think that's what you're getting to. So we're regulated by the OSC, and our offering, before you invest, we have an offering memorandum that goes to you. You read it. It discloses all the risks, all the fees, a lot of details about the business. It's about 40 pages. That gets registered with the OSC as well. And we have to stick to those fees, and it's disclosed. So our fees generally are, there's no transaction fee. We recover some fees for due diligence. So far it's been 20 to 30,000 per transaction. It's disclosed, because we're not hiring, we're doing a lot of the in-house due diligence for financial. Then there's fees for legal. So generally transaction fees are under 50,000 for us, which is quite reasonable. On top of that, we don't take any management fee. There's no management fee charged to the company of managing the holding company. So we're not changing any fees. But if we take an operating role within the company, then we charge the company that fee, which is also disclosed. And in addition to that, we take a carry. Each deal is different, but typically our carry is the fee we get performance fee. And generally it's a 20% straight carry, no hurdle. And if you sell and you don't make your money back, in that event, there's no carry as well. So there's no charge if you don't make your money back. But on all the distributions, we charge a 20% carry. And you get that quarterly report that discloses all that as well, all the fees charged during that time. And again, because we're regulated, every year, every investor receives an annual report. Just like if you invested with a wealth manager, you get your annual report disclosing all the fees and details about your investment. So we target 25% after all fees. If every deal, like the first deal that we invested in, that will likely be over a 50% IRR, because it's doing really well. Like this year's profit may be 100% of our investment amount, which is fantastic. So we might pay 60 to 80% dividend only this year. So if that continues, it's a fantastic return. But there's no guarantees, obviously. It's a equity risk. You could lose money. All those wonderful risks are disclosed. But we target, because we're paying at 3 times EBITDA, if nothing changes, you should be getting 25% return, if it doesn't decline. But we're hoping to obviously grow the business, right? So where we do charge fees to operate, so it does reduce the profits a bit, but then hopefully that's a positive investment, and then it helps grow the business. And in such companies, it's usually the liquidity that's the issue. So we do self-finance as well. So for example, we bank with RBC, our whole portfolio, and we're able to remove personal guarantees from our portfolio company. So in Canada, generally, if you have a small business, the bank will lend you money if you give a personal guarantee. It's quite simple. But because we have an investor group, we don't give personal guarantees. But because of our relationship and they like what we're doing, those personal guarantees and corporate guarantees have been removed. So. Yes, so far I've invested in all the deals, yes.
That's good to know, but as a corporation, for example, it's part of the 20%, charge for the invested in companies or investments?
No, so if we were going to invest in another company, it'd probably be a separate transaction. Yeah, but the company itself, or so personally, I've invested in every transaction as myself to take advantage of the capital gains exemption versus through my company. And the company itself, would it buy another company? Is that if the situation merits, but you're not forced to. Let's say you need to raise $1 million. We don't want to be in a situation forcing investors to inject another $1 million if it needs. So we might do it as a separate transaction. And then because we control management, we could combine in an exit situation, we could combine the two in an exit.
So the shareholders are shareholders in the holding company. So we choose the transaction which we want to invest. But how do you discriminate between the different shareholders? I mean, at the end of the day, all these shareholders are sharing all the risk for all the transactions together.
No. Each holding has only one investment. It's not pooled. Yeah.
But each transaction for each project, you establish a new holding company.
Correct. Right? For two reasons. Yeah.
So the way we have a concept of SLP, which is with the financial story, the crowdfunding, whenever you are going for the real estate, so let's say you crowdfunding, if you're in real estate, everyone will be SLP and then under SLP and all the stakeholders.
Yeah. So for us, it's direct, mainly for the lifetime capital gains exemption. Yeah.
To the team, they provide insights on the outlook, financial outlook, and the growth plan for the company.
So we do research ourselves. So in the offering memorandum, we do analyze the sector. Is that what you mean? Yeah.
There's an opportunity there, and what might be the ROI after 3 years or 5 years, 10 years?
Yeah. So we do the outlook for the sector, and we do project out what we expect the cash flows to be and the expected return. So that's all in the offering memorandum.
Yeah, because I think this is going to be the major element for an investment to go and buy a share or to invest in a company.
Yeah, absolutely. So all that is disclosed in the offering memorandum. At the end of the day, it's the investor's decision to make.
The holding
Sure.
I was just going to ask, the holding companies you establish are Canadian companies that are Ontario.
Correct. Yeah. Yes.
I'm sorry I was late, so I may have missed this, but I want to ask, what's the difference between investing in stocks and investing here? Is it higher risk, higher return?
So stocks would be definitely more liquid. So you own Apple shares and you could sell it tomorrow. The difference with private equity, with private investments, is generally a higher rate of return. So yeah, that was our second slide. It's usually, if the equity markets are returning 6%, 7%, on average, private equity is over 12, 15. We target, ours would be, you could say, higher returns than average, but there's obviously higher risk in a small business than in a large business. So you have equity risks, small stock risk, but it's also designed for someone who could write a $50,000, $100,000 check and not really worry about it too much. It's a long-term.
And what would be the minimum time that you have to keep the money there? Is there any timeline?
6 months is the minimum. Yeah, then you could trade. But yeah.
And can you do that online or you have to?
It is through the platform. So I'd love to show you the platform, but so it's a very nice platform, I have to say. We've invested a lot of money in it. So you do all the communications. You could communicate with us through the platform. You could, if you want to sell your shares, you press sell my shares button, set your price. The data room is there. All the legal documents are there so that you have it all in one place.
And may I ask how big is the company?
That we invest in.
No, your company.
How big is it? So it's I started the company. So full time we have one partner that's full time. We're taking advantage of a new program in Canada that promotes student internship. So we have 12 free interns right now, which is great, paid directly by the government of Canada. It's fantastic. And then we have other partners who we work with that are not full-time. Like the second deal was brought by one of our partners. He helps manage that company. And he has a marketing background that we work with. So that's the size. Yeah.
Is this only open to Canadian citizens or anybody?
No, anybody, but it's the Americans. We're not working with Americans right now, so that's one of the.
It's targeted purely to citizens or Canadian residents?
So right now, it's the investors are actually, we're targeting is Ontario only, because we're only registered in Ontario, and then abroad is in Dubai.
Connected with this, some of the people that live here, they are non-resident tax officers, especially if they live here for a long time. Will those people also have access? Or?
Absolutely, yeah. And there's a lot of tax advantages of that. And I gotta go. Wayne wants to talk. All right, my time's up. All right. Oh, is it? Oh. All right. So we're shutting down. Thank you for coming, everyone. No, I'm handing it over to Wayne. Thanks, everyone.
All right, thanks everyone. So my name is Wayne Buick, very happy to be here. Good to see Sangeeta again. I first came in 2007, and I've been coming every year since doing this presentation. So Sangeeta's heard it a few times. So thanks a lot to the CBC, both in Dubai and Abu Dhabi, for having me. It's always good to come. I always come at this time of year. It's not too hot, it's not like it's summer, and it's good to get outside of Canada. So very happy to be here. Yeah, so I specialize in international tax for Canadians working abroad, for Canadians living abroad, and for people moving to Canada. I'm a managing director / partner in the company. 3 of us started it 20 years ago, and now we have 170 people. We do Canadian tax, US tax. We actually do a lot of US tax because, I don't know if you guys know, but Americans have to file every year no matter what. So if you get 10 clients as Americans, they keep filing every year. And Canadians, once they leave, they only have to file once, hopefully. So we do a lot of US tax. We do UK tax as well. And we do a lot of corporate tax as well for companies leaving Canada or companies going to Canada, and also a lot of US corporate tax. So really anything tax related we do. We have offices in London. I lived in the UK for 12 years. Germany, 2 offices in India, and in Canada as well. So, and we've been talking about finally opening an office in Dubai, so hopefully next time we're here we'll actually have an office. Because the good thing about coming like once or twice a year, this place changes, like it's insane every year. Traffic gets better. No, just kidding. So that's the one good thing about sort of coming here. So I think we'll probably open something up. So I'm going to try to go quickly because really there's only so much time people can listen to tax. It's probably really about 5 minutes, but I'll go longer than that. And so I'm going to talk about the common themes. Canadian residency, you know, are you a resident for tax purposes? Are you not a resident? That's always a big thing. You know, do you have a property in Canada? Have you rented it? Have you sold it? There's been a lot of changes recently in regards to having properties in Canada, so I'll touch on those. The departure tax return, you know, did you file your return properly to get outside the Canadian system? Going back to Canada, and, you know, voluntary disclosure and amending prior returns to fix things. So I noticed someone's taking a picture. That's totally not a problem. But if you want slides, you can just email me or email, and we're happy to send it out too. So yeah, so don't worry about it. All right, so I like starting with what's new, and for the longest time I would basically wake up and I would change the date on the presentation and then do this presentation, but because not much has been changing in international tax. But this year in the last few years, there's been a lot of changes around housing affordability in Canada, and so a lot of they're going after a lot of housing to try to keep it affordable. So one thing they came out with last year is the underused housing tax. And basically that's to try to stop people from keeping empty properties in Canada. So, you know, a lot of times, you know, someone from some country would buy 8 properties and just leave them empty. It would increase rents and make it unaffordable. So there's a 1% tax on properties that are left vacant now in Canada. Now, if you're a Canadian citizen, permanent resident, that doesn't apply to you. So it's really a tax on non-Canadians. But it's you know, something to be aware of if you're in that situation. There's a new anti-flipping rule where if you bought a property and then sell it within a year, you don't get capital gains rates, you get income rates. There's now a first-time home savers account for Canadian residents. It acts like an RSP, you get a deduction, and then you can pull the money out tax-free to buy a house. There's also the Ontario non-resident surtax, which is now 25%. Now this is classic Canadian government because they call it a non-resident tax, but actually if you're a Canadian citizen or a permanent resident, you can still be a non-resident and it doesn't apply to you. So it's not really a non-resident tax, it's more of a non-citizen tax. And that's 25% province-wide. BC has one that's 20%. You know, Nova Scotia has one that's 5%. That actually applies to non-residents as well of Canada. So there's been a lot focusing on properties and ways of trying to keep them affordable. It's probably 5 to 10 years too late, but if you've owned properties, then you've done well. BC also has a speculation and vacancy tax, and Vancouver now has an empty home tax that for this year is going up to 5%. So you can actually have a property in Stanley Park if you're not a Canadian citizen and pay 8% a year on a vacant property. So it's the value of the property, yeah. It's reassessed, so there's two ways, like valuation based on city taxes or fair market value. There's different ways of doing it, but yeah. So that's been a lot of changes on properties. Some other things now, this isn't really new, but it always comes up, is transfers of $10,000 or more, the CRA now gets copies. So this has been a few years in the making. Like, the transfers used to always go through anti-money laundering and anti-terrorism and all that, and now the CRA actually gets copies. I always say I don't recommend transferring like $9,999 to keep under the radar because that looks worse, I think. And if you're doing everything legally, it's totally not a problem. You know, if you're working abroad, you're saving money, you're doing it, just transfer it. It's not a problem. We did have one situation, and this was someone who was in Canada, and they said they didn't have any money abroad. I think it was someone in Abu Dhabi, actually. And they did 2 transfers of $500,000, right? And then it went to the CRA, and on their tax return, they said they had no money abroad. And so that's kind of what CRA is looking for. But if you're a non-resident, you're earning money, don't worry about it. CRA delays, I like to say this because our clients sometimes get very angry with us because they're like, why is the CRA not getting back to us? We had one client who we're working on, it's been like 4 years that we've been trying to get him a refund. So, and the CRA may go on a strike this year. So, and then with COVID, everything got focused to COVID and the international group just kind of shut down. So, anyway, just be patient with your accountants. Yeah. Yeah. Yeah, unless maybe if you had a record of sending it in, but yeah. One other thing is the common reporting standards. This is if your bank sends you a letter and asks you where are you a resident and what's your tax number. I don't know if anyone's got those letters. It's a standard thing, just don't worry about it. Sometimes people get worried about it. There's another thing that I haven't put on here that I used to have on it. There's something called the whistleblower provisions now. And so if you know someone who's doing something illegal, you can let the CRA know and you'll get a bonus kind of thing. They'll pay you money for kind of ratting on someone. So the funny part about that is that 2/3 of the people that called the line are ex-spouses. So I don't think they thought that would happen, but that, yeah, exactly, spying on each other. So if you're at a party and someone says something wrong, no, I'm just joking. That's how we always make our money because there's someone here who's done something. Yeah, exactly, yeah. No, I'm just kidding, It's kind of bad, so. This is just for fun, just for reminding people of the joy of the Canadian tax rate. So now the top tax rates are typically when you're over 200,000. So that's a bit much, but you can see a lot of the provinces are now still up over 50% tax. And when we get into residency later about why it's important to make sure you're non-resident, it's so you don't pay these taxes. And then now the question is when, obviously, the UAE will Quebec's 53, yeah. It's typically, in the olden days, we used to be able to do some planning where you could move someone at the end of the year from Quebec to Alberta because the top rate in Alberta was 38%, but now Alberta's like 48 as well. So, but yeah, it will be interesting to see what happens in the UAE with taxes. How, you know, first you start with VAT, then it's corporate tax, and then what's next? What's that? Yeah, it's just a matter of time, right? Like, so. And then I just want to throw these numbers in again. So, you know, if again, on $200,000, you'll pay about $73,000 in tax. And the thing about that is if you're over here and you're getting your housing paid and certain car allowances, those all add, those are all taxable. So sometimes it's pretty easy to get up to a higher number. And then over 3 years, on even $100,000, there's $81,000 in tax. And so that brings us to residency. So if you're a resident for tax purposes, you're taxed on your worldwide income. If you're a non-resident, you're only taxed on Canadian income. And even that, the capital gains aren't taxed and interest income is not taxed. So that's why it's extremely important to make sure you're a non-resident for tax purposes. It has nothing to do with immigration status, although I will talk a little bit about PR later. It's really about where are your ties to Canada. And so how does Canada know if you're a resident? There's no way of them knowing because there's no real rule. It's this kind of haphazard rule of ties and what's your intention. And so if you have an intention of going back to Canada, the CRA is potentially going to deem you as a resident for tax purposes. So you see the NR73 filing. Now some of my stories are pretty old. But I remember it was in 2009, I was in Abu Dhabi doing a presentation, and someone sent in the NR73, which you don't have to, so I recommend never filing it. And they said they planned to go back to Canada on this form when their kids were in university. And the kids at the time were like 3 and 5. And CRA said, well, since you plan to go back, we see you as a resident for tax purposes. Now, we fought it, and it was fine. But that's why you shouldn't necessarily file the NR73, or if you do, make sure you get professional advice. Now, the irony is that I would say 90% of Canadians at some point go back. Like Ara went back, he missed the weather. It's amazing. I keep hearing him talking about how much he loves the Canadian weather. But so how do you figure out your residency is if you have a lot of ties to Canada. And they say, well, if you have a lot of ties to Canada, then you intend to go back or you haven't severed it. So a lot of the big ties is, again, do you have a vacant home in Canada? So if you just have a home in Canada available, it's not rented out, then they'll typically say, you know, you're a resident of Canada. If it's just a vacation property, that's different. But typically you don't want to have a home available. And if you have your spouse and children in Canada, then they're going to say you're a resident of Canada for tax purposes. Mostly, there's 2 reasons. One, they say, well, you know, you wouldn't really leave your spouse and children in Canada if you didn't plan on going back. Although some people have said that's why they left. Just kidding. And then the second is they don't like it if the people that are living there aren't paying tax, but they're using all the benefits. And then the person over here is making all the money and not paying any tax. So that's why typically the spouse and children are a big one. And then there's another one, do you have a job available in Canada? So those are kind of, yeah. Yep. So this is a question that comes up a lot, actually. The question is, you know, if you have a child in Canada and you're paying for their university, now if they're over 18, you can't really control them, right? You can't force them not to go. And so even though they're probably very dependent on you for living and school and everything, under these rules are not considered dependent. Because, you know, you can't, like, kidnap them and keep them here, so. Yeah. Yeah.
No, just wanted to info, so it's 18 and above, or
Yeah, so typically, yeah, 18 once you're legal, right? Now, if they're like, sometimes they're in boarding schools and things like that, like there are other situations that you may want to do it. I'm just saying if you want to be as clean as possible.
I'm going to get the other mic because I want
The questions to be,
captured
okay.
in the live recording.
Okay. Yeah.
The question of the gentleman is you're funding your kid in university school there, but you're paying into a person's bank account of your wealth transferring from your account to his bank account, transferring from your own account, and you have bank account in your name and then transferring money.
Yep.
That is what would qualify, and then what you said is that the parent is a resident.
No. So the question is, if you're transferring money from an account you have here to an account you have in Canada and then giving it to your child, having one bank account could be is part of the secondary ties that I get into, but that transfer of cash is not taxable, and that won't necessarily make you a resident. It's a good lead into, there's all these sort of secondary ties as well. So if you have a lot of secondary ties, you can also be considered a resident for tax purposes. That's why you want to, get rid of as many of those as possible. So, having a bunch of bank accounts, having credit cards, not canceling your provincial health care, not canceling your driver's licenses, all those sort of things. If you have enough of those, you can still be considered a resident based on secondary ties. Now, there could be reasons why you have a secondary tie. If you have a rental property, you're going to need a bank account. If you're collecting investment income, you're going to need that. So there are reasons, but again, you'll just want to make sure you minimize your ties as well. So, and then there's the NR73. If anyone knows that form, it's a determination of residency form. If you call the CRA to ask about your residency, they're going to tell you to file it. And you don't need to. You're allowed to determine your own residency. So don't do that. And secondly, never rely on the CRA for information. They're really great people, but they're not necessarily, even in the international tax group, they're not trained professionals, right, in that. So.
If you have met the primary requirements.
Sorry, can you just, thank you.
If you have met the primary requirement, will CRA go through the secondary, or it's just almost ignored?
No, I mean, if you met the primary and they see you as a resident, they won't bother.
They won't bother with the secondary one?
No, because they'll see you as a resident for tax purposes.
Okay. Second question related to that, when you exit, do you need to be a tax resident somewhere, or can you be a tax non-resident of nowhere?
That is an amazing question. So the key thing, and what we typically recommend, right, is being a resident of somewhere, right? Because CRA will take argument that you can't be a resident nowhere, right? But there's no law that says you can't be a resident nowhere, right? So you can fight it. It's just, it makes it harder. If you start nomading around, you can still argue, but it would be better if you were somewhere, so.
So just follow up with that. For Dubai, then you would have to get your tax residency certificate, or do you just say that you're a resident of Dubai?
Well, it more would depend on, if you have a place here, if you're renting an apartment, if you have a job, if you're living here, those things would be fine, right? Those are kind of things that you would show that you have residency in another place. So. One thing I always like to say too is that sometimes if you're asking a question, you might want to say, my cousin has this situation, or my friend has this situation. Yeah, asking for a friend. Because I think it was Dubai, there was one time we had someone here, and he kept going on about how he was in resident in Canada, and he's like, I don't declare any of my money, they never know, and he was telling this in front of everyone. And just after I had told the whole whistleblower thing, I was like, you gotta stop paying that. So I'm just kidding, but okay, so there's another way. So the things we talked about being a factual resident is, if you have the ties and everything like that, there's another way of becoming a resident, and that's called the sojourner. So if you spend more than 183 days in Canada, then you're considered a resident for the whole year under the sojourner rules. So, oh man, I didn't change the Qatar slide, don't worry about that. And that happens a lot sometimes where we see where one spouse will go back to Canada because they have a family member who's ill or something like that. So it's just something to be aware of, that that person, if they spend more than 183 days, will be a resident for the year. Obviously I just did this presentation in Qatar. I forgot to change the slide. So the one thing is, so Canada does have a tax treaty with the UAE, but it doesn't work for most people. Because to qualify under the treaty, you have to be an Emirati. And so I think it's pretty impossible to become an Emirati if you're not an Emirati. So you really can't use the treaty. Because if you go to a lot of countries, the treaty will say if you're a resident of one country, then you're automatically a non-resident of another. But because the treaty doesn't work, you can't use that, and then you have to go back on domestic. And that's where we talk about ties and everything like that. Yeah.
You mentioned like 183 day rule. You said earlier that they cannot control the time that you're staying in Canada. Can they control how long you stay in Canada?
No. No. They can't control, but it's like if you can stay under 183 days. You know what I mean? Like if you're going back and you're getting close, then you can get out of the country and only spend 180 days instead of. And now the 183-day rule also doesn't apply in the year you leave Canada. So there's a different rule for that. That's just if you're living abroad and you go back to Canada. So you guys are fine. And so what happens is if you pass more than 183 days, you're taxed on the worldwide income in that year. So that's just another.
Are they computed on a rolling basis or within
It's a calendar year. Yeah. Certain other tests are on a 12-month rolling basis, but this one is a calendar year. So so sometimes people spend the last 5 months of 1 year and the next 5 months of 1 year and be fine. Okay, so the Canadian departure return, this is how you get out of the Canadian tax system. And so what happens is when you leave, you file what's called a departure tax return. And on your last tax return, there's a box that says, did you enter or leave Canada? And you have to indicate the date you left to become a non-resident. Otherwise, and what we see a lot of times is people just keep filing, or they just file in their last year and then they stop. And if you do that, you're still a resident for tax purposes, and you're still taxed on your worldwide income. So it's incredibly important to make sure you do that final tax return correctly. And there's a bunch, I won't get into all the specificities of it, but there's a lot of different things that happen on your departure return. For example, there's a T1161. If you don't file that form, there's a $2,500 penalty. You're deemed to have sold all of your assets on the day you leave, and that's assets outside of RSPs and doesn't include Canadian real property. But the point is there's a lot of complexities in the last return, and it's important to make sure that you're working with someone who understands international tax, because there's so many Canadian professional accountants that don't work in the space that get things wrong. Like I was talking with Ara today, and he kept saying things that were close, and he's an accountant, but they weren't right. And he doesn't do tax anyway. But the point is, just make sure that you're doing it right. You're talking to a professional accountant. Don't always believe your expat friends too. Like they have really good stories. So be careful what you hear from your expat friends. So I just wanted to make sure of that, because we see a lot of people get into a lot of problems. Yep.
How far can you back?
So you can go back up to 10 years under the fairness provisions. And so, and I'll talk a little bit about that later, but sometimes it's good to go back. And sometimes you can get money back too. Like sometimes people will pay extra tax that they didn't need to because they didn't realize that they should have been a non-resident. And it's really not a big thing. We do it all the time. So many times people come to this and they're like, oh, I just left and I just stopped filing. And then we just correct it. It's really nothing to worry about. So if your friend did that, yes. then your friend's fine.
There's a time limitation for the Canadian government to be able to go back and get for the last 3 years. So
there are 2 things. There's 3 years. Technically something is statute barred after 3 years. But we've always seen they'll go back 10 years and do this under fairness provisions if you want to go back and amend it. They can't go back after 3 years unless they think it's fraud or something like that. But if you want to go back and correct something for whatever reason, you know, you can go back for 10 years. So, yeah, so that's a good point on the differences between statute barred returns and fairness. Okay, so can you have a property in Canada? This comes up all the time, and the answer is yes, you know. But we recommend, again, for various reasons, not keeping it empty, you know. Now there's also a whole host of taxes for keeping it empty, but you don't want to be seen as having a home available for your use, because that's a major tie to Canada. Now, if it's not available year-round and it's in a cottage place, you know, that's fine. And we have seen a lot of times where people will be abroad for 10 years, you know, and then they go and buy a property, and it's still available year-round. I haven't seen that challenged. I haven't seen the CRA challenge that, because you could be anyone doing that. Is it recommended? I don't know. I haven't seen any problems, but it's more so if you're just leaving Canada and you just leave your house there empty, that's when they're really going to, you know, you'll put yourself at risk for being seen as a resident. Yeah.
I know a person
Yeah.
in Canada, and they bought some property, and it's been sitting there. Is that the same? Does that qualify as the same by having property?
And so is it just land?
It's just land.
Yeah.
So they haven't really built on it, so he says.
Yeah, exactly. So it's a no, that doesn't count, because you can't actually live there, right? It's not, you're not going to try to live, no matter anywhere in Canada, really, you know, so it's not considered a home available for your use. So it wouldn't be considered a tie for tax purposes. Okay, so you can have a property. We typically recommend renting it out if you can. And if you do, then there's a bunch of filings that you need to do, and it's important that you actually do the rental filings. So if you have a rental property, and the reason is that there can be a lot of penalties. So what happens, say you're renting out a property for, just say $4,000 a month, which these days in certain places isn't that unrealistic. Technically, you're required to remit 25% of the gross rent, $1,000 a month, to the CRA. And if you don't do that, they can penalize you with that amount, even if you're not making any money. So a lot of times people don't file because they think, well, I'm losing money, I don't owe any tax. But if you don't do things properly, you can be hit with a penalty of $1,000 a month. So it's just really important to make sure you do your rental filings properly. There's two ways of doing it. So you can either, if you're renting it for $4,000 a month, you can remit $1,000 a month, right? And then file a tax return. Or you can do something called an NR6, which is at the beginning of the year, you estimate what all your expenses are, right? And so say you're renting it for $4,000 and your expenses are $4,000, then you file this NR6 and you don't have to remit anything to the government. Now at the end of the year, it doesn't matter because you have to file a tax return. And if your net income is zero, in the first instance when you paid in $12,000, you'll get the $12,000 back. In the second, where you paid in zero, you won't get anything back, but you won't owe any tax. But if you don't do anything, then they could hit you with a $12,000 penalty. So the key is just make sure that you do stuff.
Can you go and amend NR6 later on?
Amending the NR6, it doesn't really matter because it's an estimate, right, that you do. And if something changes during the year, like you lose a tenant, you know, when you file your tax return, it'll all clear itself up. So it's
resource to do that?
That's actually a good question. So the thing is, to use the NR6 method, right, you have to have an agent in Canada who is responsible for your taxes and basically says, if you don't pay, then they have to pay. And so we act as an NR6 for a lot of our clients. We just act as the agent. We help with the remittances and everything like that. You can also use a family member. Sometimes people just have the family member and they'll take care of it. But you do have to have an agent if you want to do that.
A legal agent.
A legal agent, yeah. And again, it could be a brother. It doesn't have to be a realtor. It could be any family member, just someone in Canada that's responsible. Sometimes family members don't want to take that responsibility. We've also seen family members who've got notices and just ignored them, and then they got hit with penalties. So, but yeah, so we have a specialized non-resident realty group that we do all these things for, just to make sure there's no issues. So.
Can your student live in the property?
So that's a question. Can the student live in the property? And that comes down to very different situations. Like if it was your house and you just left and your children are still staying in it, then that's a big risk. You know, if you lived in Montreal and your kid was going to school in BC and you bought them a property and they're living in it, that's a very different situation as well. So, you know, you want to be careful that they're not just staying in the house that you bought.
So if you bought the house after you became non-resident, it would not be considered as a tie?
It could be.
It could be.
You might be fine. And a lot of times what we'll do is, you know, it would be better to have the property in the child's name, right? And then you take some type of like debt against it. So they can't just sell it, you know what I mean? But it's in their name, because then they get the principal residence exemption. They might get a first home buyer's credit.
But if you pass it to their name, then you're going to have to pay capital gain.
Yeah, so it's typically better when you're doing it initially, right? If you're doing it later on, the capital gain is going to be due anyway, so it still might be better to do it, because then any future growth is in their name.
And the capital gain, is there a way to escape that when you sell the property being non-resident, or it's 20% of the capital gain?
No, and wait, I think this is on the next slide, actually. Wait, so I talked about this. So the sale of the property, I'm going to go through it. So when you sell a property, you have to get something called a clearance certificate, right? And what happens is, say you sell the property, it's $1 million. The lawyer is required to withhold a minimum of 25%. So the lawyer is going to withhold $250,000. Sometimes some will hold up to 50%.
When you buy or when you sell?
When you sell. And what that is to make sure you pay the capital gain on the tax owing. So say you bought this property for $900,000 and you sell it for $1 million. There's a $100,000 gain, right? When you get the clearance certificate, you get the amount reduced from 25% of the gross, so $250,000, to 25% of the gain. So then it goes down to $225,000, okay? Then when you actually file a tax return, the actual tax on that would probably be around $11,000. Because what happens is 50% of the capital gain is not taxable. So then you only have $50,000 of taxable income, and you'd still be in the lowest tax bracket, around 22%. So there'd be $11,000 of tax. So when you file the return, you get the $14,000 back from that. So you can't eliminate it. If it's your principal residence for a few years, there's certain things you could probably do, but typically there's going to be some type of capital gain. But even on $100,000, the gain's only $11,000. So Canada is not bad from a...
So it's 20% of the 50% of the capital gain?
It's around 22%, because you go in the tax rates, and it depends. So if your gain's $400,000, then it's going to be at a higher... The other amount will be like 26%, right? Because it goes up, so... But typically it'll be around that, so.
Does it apply to the principal property as well?
It depends. If it's your principal residence fully, then there's no tax at all. But if it was rented at certain points, then certain parts of it might be taxable. Amending prior year tax returns. So you can go back, again, up to 10 years under the fairness provisions. If you've done something wrong and you want to correct it, if you've gotten bad advice, if you think you can get money back for some reason, you can go back. So if your friend didn't file a departure return, he or she can go back and correct it.
But let's say you failed to produce the tax returns for a specific year. and whatever during COVID, for example, and then you've produced your NR6 for that year, but you missed to produce the tax return, and then you get penalty of 25% over the gross rents.
So that's one thing about the NR6, and anything, if you file it and you don't file the tax return by June 30th, you just get hit with a 25% penalty. And we've seen, and there's just, you'd have to go through a fairness provision, but it would have to be something like there was a hurricane and you lost all your documents. Like, it's really hard to get it withdrawn. You might try because of COVID. There might be some, I haven't seen anyone do that, but yeah, it's important when you do that NR6, or even if you don't, to make sure you file on time. So. Yeah, so you can go back and correct things, and we do it all the time. There was a bunch of times that we do stuff in Qatar. There used to be a Canadian school there, the College of the North Atlantic, which now switched over. And people there, they were being paid from Canada, and they just kept paying tax every year, even though they didn't need to. So you can go back 4 or 5 years and sometimes get them back like 100,000. It was really good. So if anyone here has filed as a resident and paid taxes, and they realize they might not be able to, you can go back and get a bunch of money back. So. Okay, voluntary disclosure. If you have done anything bad, I won't get into this too much, but if you've done anything bad, instead of just going forward, you can go through a voluntary disclosure program, and they'll waive the penalties. So the best way of doing it, and I tell this story all the time, is my grandmother. Okay, so she came to Canada like 50 years ago. She was from England, and she had some money that she inherited from her mother that was in England, and someone had told her she didn't need to declare this income in Canada, right? But Canada taxes you on your worldwide income. And so I told her this wasn't right. She had to correct her, she had to include it. And she was using some other accountant, because I was younger and I went traveling for a few months. And so she filed 15 years of tax returns and got hit with an $80,000 bill, right? So I was definitely not the favorite grandson then, but she wanted to do things right. But what the accountant did is they just threw the tax returns into the system. And so $40,000 owing was taxes and $40,000 was penalties and interest. Now, had she gone through the voluntary disclosure program, they would have waived the penalties and likely a bunch of the interest. Because what they want to do is they want to encourage people to come forward. And if you know you're going to be hit with penalties and interest, you might not do it. Now, the tax isn't going to go away, but this is a way of doing it under the voluntary disclosure program. And so we see this a lot of times where people have had offshore income and they didn't disclose it because they didn't know they had to, or in like that. And there's a lot of sharing of information between agencies. So if you do want to come clean that way, just go through a voluntary disclosure. Don't call it the CRA and let them know. So, has anyone here done anything illegal? No? All right. Just thought I'd see. Those are my little fun accountant jokes, you know? Okay, so one last thing is grantee trust planning. Okay, now there's not much really good tax planning you can do in Canada anymore, but this is one of them. And to do this, you don't have to be a granny. So, but typically, I guess women live longer than men, and so typically it was the granny who was the last person with the money. And quickly, how this works is if you have parents or relatives outside of Canada, and they die, say they die with $3 million. If they give it to you, it's completely tax-free, right? But if you're living in Canada and you have $3 million and you make 10% interest, or higher if you're using ARA, you would pay tax on that. So just say you make $300,000, and let's assume it's not capital gains, you might pay $150,000 a year in tax. Now, instead, if in the will this money goes into a special trust, and this $300,000 is paid out the year after it's made, there's no tax. So if you have relatives abroad that aren't going to live in Canada, that don't live in Canada, and you're going to inherit a lot of money, you would want to look at this. If your parents are in Canada now, or they're going to move to Canada, that throws it off. But this is something for anyone who's going to inherit a bunch of money. You have to be in a very specific situation, but I did want to mention that.
And this is only when someone dies. You cannot leave it in your life.
Well, you can set up a different type of trust, like an inter vivo trust. And you know what, to be honest, we have trust people. Let me double check on that. I think, yeah.
What about the opposite? If you have an inheritance coming from within Canada and you want to bring it to, say, Dubai?
Yeah, so inheritances are always tax-free. Because what happens is the person in Canada pays any tax when they die. So for example, say they have an RSP, it's worth $400,000. That gets taxed in their hand, and then anything you get gets paid out to you. If they have a property, like they live in their home, it might be completely tax-free because of the principal residence exemptions, and then it'll get transferred over to you at the cost on that day. If you do sell it later and there's a bit of gain, there will be a bit of tax, but there's no tax on doing it. Any stocks, they're deemed to have sold it on that day, and you inherited that value, so there's no tax on that. So, yeah, because they pay everything. Okay, arrival back in Canada. Like I say, a lot of people go back. So what happens when you go back is you're, again, taxed on your worldwide income. So if you have a property here and you're renting it out, you have to pay the tax in Canada on any net income. So it doesn't matter where you have assets in the world, they're going to be taxable as of when you go back. Say you go back June 1st, you're taxable from that day forward. Anything that happens beforehand is not taxed. So, you know, you don't, in that year, you don't have to worry about the 183-day rule. It's really when you land. There's certain things to be very careful of, though. A lot of times people will get end of service gratuities or something like that, or bonuses. If you get those when you're a resident of Canada, those could be taxed in Canada. So it's very important to make sure you're planning any payments. If you have stock options or anything like that, if you can, make sure you get them paid before you go back. So that's why it's important to make sure you think about things and you just don't go back. Yep.
So while we're on this topic, it's a very big topic. Let's say if we have two units here, residential units, are they going to be at the purchasing price of that unit when it was bought, or it has to be on the fair market value at the day then you are leaving?
So that's a good question. So the question is, if you bought a property 10 years ago for whatever, 200,000 dirhams, right? And now it's $1 million. Canada is going to tax the gain in the future, but only from the day you go back to Canada. So whatever happened beforehand, it doesn't matter. It's as if you bought the houses on that date. And then you will pay.
The capital gain that's being collected while you were not there is not going to be counted.
So that's for properties outside Canada. If it's a property in Canada, it's always taxable. So stocks in Canada, any gains as a non-resident are not taxable. But real property is always taxable. But if the property is over here, it isn't.
I'm talking about outside Canada property.
Outside Canada property. Yep.
When I'm going back, it is million.
Yep.
So the document that I'm going to fill, should I go to...
It'll be $1 million. $1 million. Yep. Yeah. It's fair market value. And I'll even give you another example, and there's an example here, but so say you owned Bank of Montreal stock, right, and you bought it for $5, and you left Canada and it was $10. On the day you leave Canada, it's as if you sold it for $10. You then go back and it's worth $20. Even though it's a Canadian stock, it's as if you bought it for $20. So the gain that happens, even on a Canadian stock, is not taxable. But again, real property is always taxable. So that's where it gets confusing. Yeah.
Coming back to the bonus and payments when you are non-resident, let's say you work and you're on your termination, you own $500,000 dirham, but that sum is not perceived on your departure because the employer delays that payment and is only paid to you after you became a resident. Now, are they going to consider the day you receive it or the day it was due?
So there's different arguments you may want to look at, right? Typically, it's on the day you receive it, right? And I don't know if anyone here has got bonuses in Canada. They'll typically pay the bonus out in January of the next year to get it taxed in the next year because it's taxed on the day received. There are arguments that you might want to say there's constructive receipt. of the payment on the day because it was due and your employer didn't pay it or something like that. You know, ideally, you want to make sure it's paid. So.
Maybe similar example, selling a property. Your same property you bought for 200,000 dirham and you were selling at $1 million. Before your departure, you receive half of that money before departure and the buyer pays the balance after you become a resident.
Yeah, so it would depend on what the official closing date is.
Everything before your departure.
Yeah, so if it's before, then you're fine. It would be official departure.
Okay.
It's funny because a lot of times it's actually better to sell it afterwards because you can actually create a capital loss. So what happens is the value on the day you come is $1 million, and if you sell it a month later for $1 million, you also have all these legal costs, right? Like realtor costs and whatever, so you actually only get $950, and so you've created like a $50,000 loss. But, I mean, that's just... All right, I think that's it. Any other questions?
I have plenty of questions. They're all coming from the online thing, so these are the 3 questions I've received, so if you want to read it and answer them.
Okay.
They're watching online.
Do you want to read them for
okay.
us, just for fun?
Okay, so it's for Wayne. It's for a Canadian citizen who worked part-time in Quebec and in Ontario for about 5 years in the 1990s, and he's currently residing overseas. Are there any federal or provincial retirement benefits if a person continues to live overseas after retirement or move back to Canada?
So that's a good question. So for CPP or QPP, whatever you paid in, you're going to get. Obviously, if you only paid 5 years, it's going to be very minimal. For old age security, if you live in Canada and you've lived in Canada for more than 10 years after you're 18, you'll qualify. And if you're living outside of Canada, you have to have lived in Canada for 20 years. So there will be some benefits, but very, very minimal.
Okay. There's another question again for you, and it's for a retired Canadian citizen who resided in Quebec but never worked in Quebec. Are they entitled to receive any federal or provincial benefits after retirement if they are currently residing overseas?
I'm not 100% sure, but I don't think so. Because I don't think they would have contributed anything to the Quebec system because they weren't working. So I don't think so.
Okay, and then finally, is there any advantage from a tax point of view to buy a property in Quebec versus Ottawa, Ontario?
I mean, I'm from Quebec, so I would say the advantage is buying it in Quebec. But the answer is no, because especially if you're renting it out, you actually only file a federal tax return. So there's no provincial tax differences. Now, if you do sell it, then you also have to get a clearance certificate from Quebec, which is weird because it's, you don't have to pay the tax there. But otherwise, as a non-resident, there's no differential in the taxes between the provinces.
Okay,
Okay, one other thing I just want to make sure is don't contribute to a tax-free savings account as a non-resident. I didn't mention that. If you do, then there's a 1% a month penalty. And we see people all the time who they've saved up a bunch of money because it's so cheap living here, and then they contribute to a tax-free savings account, and they put $40,000 in, and then 3 years later they get hit with a massive penalty because it's 1% a month, right? So if you put in $40,000, you get a $400 penalty, and then 3 years later it adds up. So make sure.
There are some more questions that have come in online. So this question is from Alex Kayat. So in case you voted in Canadian federal elections, are you considered someone with ties to Canada and ultimately a resident of Canada?
It depends who you voted for. No. Typically not. I mean, I've never seen that happen. I don't think they'd want to penalize someone as a Canadian for exercising their right. It could. I mean, I guess if you had a lot of other ties, but yeah.
Okay. Another one, this is from Fazi Molana, and he says, hello, I have a question. So if you are a non-resident and then at some point in the future decide to come back to Canada, can you bring your non-taxed funds earned in the UAE back to Canada tax-free?
Yeah, so anything you've earned here, you can bring it back, you can leave it here. There's no tax implications.
During the time that you lived here?
Yeah.
You earned while you were not in Canada.
Yeah, yeah. But then as soon as you become a resident, any income earned, whether it's here or there, wherever, is taxed. But everything beforehand, it's so funny because I used to actually, I forgot about that joke. I used to always joke that when people go back to Canada, there's a 50% arrival tax. And people used to be like, what? But I totally forgot that. So yeah, there's no tax.
And then finally, it's from Tracy. Tracy says, thank you for an excellent presentation. And she wants to know, I'm an NRI and I receive an inheritance in Quebec. Currently, my 18-year-old daughter is in POA with the inheritance.
Power of attorney, yeah.
When I repatriate, will I be charged when I receive this inheritance?
So there'll be no tax on the inheritance, but if the money is sitting in trust or something like that, and income is being earned, then there will be tax payable, but not on the full amount received. It's just on any income after it gets transferred over. So. And that's right in the what? Yeah, so that's a question, very loaded question. Do you have any thoughts on estate planning and wills? That's not my specialty, but I'm definitely happy to pass on some names and stuff like that. So we have a lot of contacts in Canada. Like, you know, if you're selling a property and you want a realtor, if you want mortgage brokers or lawyers, immigration lawyers, financial advisors, wealth management, like there's a lot of contacts. So happy to help out that way. All right, thank you everyone for staying. I know it's not the most.
You can take it one-on-one with them.
Thank you.
I leave my business card. So I'm